Hey everyone, this is YCHARTS, a small investment firm that specializes in real estate investing, and in today's video I want to discuss why over the past 2 years I've been mostly investing in publicly listed REITs rather than private real estate. And there's really one main reason for this. Currently, investors are offered an exceptional opportunity to profit by arbitraging the difference in valuations between private real estate and publicly listed REITs. During most times, REITs are priced at a premium relative to the net asset value, so the value of the real estate they own net of debt, and this makes sense when you think of it because REITs are liquid, they are diversified, they are professionally managed, they enjoy economies of scale, they provide limited liability to investors and many other advantages, and this is worth something, and because of this, REITs typically trade at a premium relative to the net asset values. However, today this isn't the case. In fact, it's the opposite. REITs are priced at pretty sizable discounts relative to the net asset values after having gone through a 2-year-long bear market. To give you a simple example, BSR REIT owns apartment communities in rapidly growing Texan markets, and its net asset value per share today is $17, but currently its share price is just $13, so that means that it's priced at a roughly 30% discount to its net asset value. As such, by buying shares of BSR, you're today essentially buying a small equity interest in a portfolio of BSR at 70 cents on the dollar, which is far more attractive than what you could get in the private market. This may lead you to think that perhaps there is something wrong with BSR, but that just isn't the case. The company is doing just fine, its rents are growing even in today's oversupplied environment. This rent growth is expected to accelerate next year. The balance sheet is in strong shape. They have a 45% LTV, which is quite reasonable. The management is very well aligned with shareholders as well. They're actually the biggest shareholder of the company, and they are actively buying back shares to take advantage of this discount. So there's really no good reason for the company to trade at such a steep discount relative to private market values. On the contrary, it should be priced at a premium given that you get all these additional advantages like liquidity, diversification, professional management. But given that you're getting at a discount, I just don't see the point of buying private real estate in today's environment. And I'm not alone to think so. Blackstone, which is the biggest private equity real estate investment firm in the world, has been doing exactly what the title of this video is suggesting. They've been selling private real estate to buy REITs instead. To give you an example, earlier this year they sold a portfolio of industrial properties at a 4.7% cap rate, and shortly after they announced the acquisition of Apartment Income REIT at an implied cap rate of 5.8%. At the time of the deal, Apartment Income REIT was actually even cheaper than that. It was trading at an implied cap rate of 6.7%, but Blackstone paid a 23% premium to acquire the company. That deal alone is a pretty strong sign that Blackstone is bullish on REITs at these valuations and it's willing to arbitrage the valuations between private real estate and publicly listed REITs. But this wasn't the only deal that they've done this year. They also acquired another REIT called Tricon Residential, paying a 30% premium in the process. We actually used to own a large stake in this REIT, and we greatly profited from this transaction at High Yield Landlord, which is my REIT newsletter, by the way. If you want to access our full portfolio, you can join us for a 2-week free trial. I'll put a link to it in the description of this video. So those are 2 REITs that they acquired this year, and now lately they've been rumored to be also targeting a 3rd REIT called Retail Opportunity Corporation. The point here is that Blackstone, which is arguably the most sophisticated real estate investment firm in the world, is loading up on publicly listed REITs instead of buying private real estate. And if Blackstone is doing that, then it makes even more sense for you to follow a similar strategy, because unlike Blackstone, you're not managing tens of billions of capital, which would limit your flexibility and force you to pay large premiums to acquire these REITs. Instead, you can buy minority positions in these REITs, you don't pay any premium, and you get an even better valuation than Blackstone. To give you an example, earlier I mentioned BSR REIT, which in my opinion owns better properties than Apartment Income REIT, and yet it's currently priced at a higher implied cap rate than what Blackstone paid for it earlier this year. But if you're still not convinced, then consider this study from the investment firm Janus & Henderson that shows clearly that REITs very significantly outperform private real estate in the time period after they've been priced at a large discount to the net asset values. In their study, they found that REITs have historically typically roughly doubled investors' money in the following 3 years after being so heavily discounted. And so here you may be asking yourself, will this time be different? And I just don't think so. You know, REITs have existed since the 60s and they've gone through countless different crises, some of which were a lot worse than the current one, and yet they've always eventually recovered and richly rewarded those who had the courage to buy them while they were discounted. Today, REITs are so cheap because investors fear that the recent surge in interest rates will cause their cash flows to stagnate in the coming years. But the interesting thing here is that REIT balance sheets are actually much stronger than those of private real estate investors. REITs typically use only a 30 to 40% LTV in most cases, which is perceived to be very conservative in the standards of private real estate investors, which typically use LTVs closer to the 60-70% range. But I think what's happening here is that, stock market investors are very short-term oriented, and so they're clearly all focused on the surge in interest rates, and they're selling REITs in anticipation of the rising interest expense. But real estate investors, on the other hand, are typically very long-term oriented, and so they're not as worried about this. And as a result, the property values have been a lot more stable than the share prices of REITs, and as a result, they've now become heavily discounted. I think that this is a great opportunity. Blackstone seem to think so as well, because at the end of the day, REITs own great assets, their balance sheets are in good shape, they won't be heavily impacted by the surge in interest rates. Now interest rates are actually starting to already return to lower levels, and therefore I really like the idea of buying this real estate at a discount to its fair value. I of course cannot predict how REITs will behave over the short run. I don't have a crystal ball, I cannot time the market, but over a long time period I would expect REITs bought at a large discount to the net asset values to significantly outperform private real estate investments, and for this reason I've been pouring most of my real estate money into REITs rather than private real estate over the past 2 years. Someday I expect REITs to again regain premium valuations, and then I will reconsider my approach and perhaps even sell some of my REITs to buy some private real estate, but in the meantime I'm doing the opposite. Now let me know in the comment section below what REITs you are buying at the moment, and also let me know if you have any questions about this topic. I'll be happy to assist you, and otherwise if you could please click the like button and subscribe to the channel, that will help me a lot to keep on growing. Thanks so much in advance. See you at my next one. Bye bye.